Hello and welcome to MF Corner. I'm Sumera Abdi. On the show today, how can you use the principles behind target date investing to meet financial goals? We ask Kaustubh Belapurkar, Director of Fund Research at Morningstar India, and a little later on the show, Harsh Rungta of harshroongta.com will join in to answer the many queries sent in by you, our viewers. So let's get started. Investing is meaningless unless it takes you to your goals. So how exactly can you chart this path? Morningstar's Kaustubh Belapurkar says that investors can use the target date investment concepts to meet financial goals. So how do you do it? Kaustubh, good afternoon. Thanks for joining in. But first, let's understand what exactly is target date investing.
So, thanks, Mara, and really thanks for having me on the show. Maybe what I'll do is just set some context. When we talk about asset allocation, right, before I come to the concept of target date investing, just a sort of re-primer on asset allocation. Various studies obviously have shown that asset allocation is the primary driver of portfolios returns. I think there's no two ways about it, and that's really what we're going to talk about, and how do we tackle that through a target date concept, right? What is target date? Now we have a bunch of financial goals for every investor, right? It could be retirement, which is a long-dated goal. You could have something like a child's education, buying a house, various different goals. And typically, you would always ascribe what you call a target date by when you want to achieve a certain purpose. Because why are you investing? Because you need that money at some point of time for the various needs, as I just described. Right? So when you put that target date saying that 30 years down the line I want to retire, or 10 years down the line I want to buy a house, how do you go about investing in a systematic fashion? How do you manage your asset allocation? And what are the principles behind that? That's really the concept of target date investing. And why is that important? Let me just elaborate that with a very simple example. If there's a sort of investor who wanted to save an X amount of rupees, sitting back in March of 2010 and said, look, I have a 10-year horizon. I think equities is a good long-term asset class. Let me buy a 100% equity portfolio, buy and hold it till the period of March 2020, and I'll able to meet my goal, right? I mean, assuming that you make a 10% return, which is what people thought is a reasonable amount of return on equity. But when you look at it, the portfolio obviously went through ups and downs, but at the end of the period, the target date of the investment, the investor actually was much poorer because the CAGR return on the equity index was just 5% for that 10-year period. So the point is that, while asset classes such as equity are very important, targeted investing helps you take measured exposures to these various asset classes. And the basic principle behind target date investing is that you start with the volatile asset classes, and as you approach your target date of investing, you start cutting exposure to the volatile asset classes and moving to the more steady asset classes.
Okay, so basically what it means is that as you near the completion of your goal, you move from the alpha generating riskier assets and move towards safety, so that whatever you have earned so far, that is at least protected, right? Does this necessarily offer superior returns? I mean, is that the philosophy behind this, or is it to keep the money safe? What should be the driving idea?
Sure, and that's a great question, Sumera, because we always think in the terms of thinking that how can I maximize my returns? I mean, that's human nature, right? But when you think about it, you're investing because you want to meet that goal. You want to service some sort of a need or want that you have at that point, and it could be various, right? But the point is, what is the best path? And the path of the easiest or the most predictable path to get there, right? Now, like we all know, equity is a brilliant long-term asset class, and there are no two ways about it. It should be a large part of your portfolio. Doing all of these calculations, trying to think about long-term, thinking about retirement, maybe 20, 30 years down the line, the basic tenet is that you start with a very high allocation to an asset class such as equities, because clearly that's the one that's going to really grow substantially, versus a more stable or a less volatile asset class, say like cash or fixed income, right? But as you start approaching your goal, the idea is not to really maximize your returns, but to kind of protect the capital that you've already grown. So, just to use an example, if I had a 30-year horizon, I might start with a 90, 100% equity, all equity portfolio. But when I've seasoned the portfolio enough, I've probably finished 10, 15 years of an investing journey, slowly start cutting equity exposure, start preserving capital to a certain extent, albeit still having an equity allocation, but bringing it down. And as I move closer and closer, the focus really, moves towards protecting that capital rather than, getting the most out from a returns base. So that's broadly the concept, that the way I would think about when you think about saving for your financial goals through a target date investment strategy.
Because, imagine if your goal was being completed somewhere around now, and you'd have this pandemic that has come in and disrupted everything. So all the hard work of the last many years that you would have put in towards, amassing that amount could have been wiped out or been in jeopardy. But Kaustubh, how early do you think people should start? I mean, do you start, say, a year in advance, or do you earmark the amount and say, okay, I've reached 90% of my corpus, and therefore it's time for me to, begin moving towards the safety of other assets?
Yeah, okay. So, there are two things very important here, right? The first thing is, even when you kind of project what your required corpus is, and you've done all the math behind, including adjusting for inflation and all of that, even in your return expectations, one, obviously you build in enough buffers, but when you're thinking about return expectations, if I'm sitting today and thinking that, look, I'm going to build a 80-20, 80 equity, 20 fixed income portfolio, and kind of project what I would think would be reasonable returns from these asset classes, I need to start factoring in that, look, I'm not going to be at 80% through the entire journey of my investing. I'm actually going to start sequentially bringing it down, right? I mean, that's the starting point. So even when you're kind of adjusting or thinking about how much you should invest on an ongoing basis, I think that needs to be incorporated into your thought process, that it's not going to be, a static, large equity allocation. It is going to be moving down sequentially. And secondly, the more important point, like you asked, that, when should you start bringing it down? Should it be a year? Should it be 3 years? I think it's a factor of a couple of things. Obviously one is, how ambitious your sort of, target was, but largely if you look at the way it is, if you have a 30-year goal, maybe like by the 15th or the 20th year, you should start bringing it down. And, there's a concept of glide path. And there could be various what we call glide paths for different investors. But the whole point is that you have to start, bringing it down once you've actually built that substantial amount. It could be 5 years before, could be 10 years before, depending on your own sort of financial position, how you're placed, and then you can start kind of reallocating. Because if you're already in a comfortable position, you can actually start moving away and keeping some risk capital on the side any which way.
Makes sense. Kaustubh, just to understand this whole concept of target date funds, you said they're very popular in the US. What exactly is the kind of corpus that they run, and do you think this is a concept that could work in India? Could it be acceptable in India?
Sorry, Sumar, I'm actually losing you because of the poor connection. Can you
I wanted to just know, what is the popularity of target date funds in, say, a market like the US vis-a-vis other investment options, and also is this a concept that could work in a market like India?
Sure. So in the US, in fact, a lot of interesting data that's been put out is that since the 2000s, the target date fund industry has actually been growing exponentially. It's currently about a 1.5 trillion US dollar sort of assets under management. So that we're talking about a significant amount of assets that are invested in target date funds. Obviously, it's still a smaller proportion of the overall US asset management industry, but when you look at it from a total Indian context, it's huge, right? But it's grown like 20-25x since the year of 2005, so that's significant. Obviously, there are reasons for it because investors put in through their 401k. But then talking about the local context, I think there is a scope that we could potentially have some of these funds available in India. But again, the caveat is that there can never be a one-size-fits-all sort of portfolio, right? Every investor will need to look at it from the context of their. So while this can be a part of the portfolio, like we talk about SLR allocation funds being a part of an investor's portfolio, but it shouldn't be the entire portfolio of the fund, but it can definitely help, a very useful tool, in terms of planning for the various goals that an investor.
All right, Kaustubh, thanks very much for joining in and for explaining this concept to us. So basically, do the riskier set of investments early on, and as you move closer to your completion of the goal, you want to move towards the safety of some, a debt or something, so that event like a pandemic or a COVID-19 situation or any other black swan event doesn't really disrupt the goals that you have in mind. A quick break. On the other side, we're going to get down to answering some of the queries that have been sent in to us. Harshunta of harshunta.com will join in. Stay tuned.